guy.
It certainly feels like, well, no, and there's going to be an end in sight, but it certainly feels like for the short term at least, now the path of least resistance feels like it's lower. And it's funny, a couple days ago, I'm like, you know what, this market just can't stop going higher. It's going to continue to grind. Rates didn't matter. All of a sudden now rates do matter.
Yeah.
But I'll tell you this as well. I do think it has something to do with the fact that the rhetoric with the Chinese continues to escalate instead of go the other way. So I think that's part of it as well. You have sort of this unhealthy witch's brew of bad news finally seeming to impair the market.
Was there that kind of support, though, for technology?
Well, I mean, that really what it gets down to. The technology has been such a driving part of overall market performance. Not only its weighting in the market, but its outperformance. And its relative performance peaked on the 5th of June. When we are the 5th of October, it actually has been underperforming as a choice other equities as measured by the S&P. And that's not likely to be over quickly. It's really just the early stage, at least everything that I can see.
Well, it's been very clear, and this was even before we started to get into the nastiness of the last couple of days, that value was outperforming momentum, that we actually had seen some rotation at the start of the quarter. But there's a lot of things that you kind of throw out the window. First of all, we were waiting for rates to go higher to really embrace the banks. And the banks have been a major disappointment, especially with the yield curve steepening over the last couple of days. So, you have to wonder how much of this really is fear of credit. We came on here last night. Tony Dwyer has had a great call on many different things, said, I don't see any concern or stress in credit. I would push back on that. I would say, first of all, if you look at high yield, we've actually gone down about 1.5 points over the last couple of days. If you look at leverage loans, and friends of mine that are in essentially deep credit markets, especially those that are associated with where there is a lot of leverage, you are seeing some stress. Not crazy stress, but to say that this is...
Are you less bullish on the financials at this point?
Not necessarily. I actually feel more comfortable holding banks in an environment where, to me, they are value, by the way. And I look at some of the defensive, but things like McDonald's, Starbucks, we've talked about those names. You're also seeing it in some of the discretionary consumer names that continue to hold up. Luxury continues to hold up. Energy continues to hold up. So I don't think that we're going straight down.
Credit markets affect the energy space more than I know it's a different scenario than it was a couple of years ago.
Theoretically, because they are tapping the credit markets.
Exactly.
They've got a lot out there. They've got a lot of debt on their books.
What do you make of the utilities literally closing on the high with rates putting up to 3.25? I mean, that's the ultimate defense.
I'm glad you're all asking those questions because I think they're related. No, I actually think the utilities and the energy sector are in a very different place in this cycle than they were the last time. They are not as levered as they were. In fact, I've talked about MLPs. I think MLPs look like a great yield play even when yields are going higher because they actually have completed a lot of CapEx. They're actually seeing consistency in terms of their cash flows. I would stay there.
But if we are to believe what Tim is saying, that is that there are signs of strain in the credit market, should we be concerned about the companies with extended balance sheets who have a lot of leverage on their balance sheets? We were talking to the Goldman Sachs internet analyst today on Squawk on the Street, Heath Terry, and he cited Netflix. The reason why we're seeing the Netflix decline, one of the reasons is because it is seen as having a very levered balance sheet. And there are concerns here with rising rates.
There should be concerns. And, corporate debt to GDP is almost 50% now. Nobody talks about it. Listen, consumer debt to GDP is north of 50%. So it is clearly a concern. But that's been the case for quite some time, and the market hasn't cared. For whatever reason now, maybe because rates are rising so quickly, the market cares.
Would you say right now that we're at a point where you should tilt more defensively in your portfolio?
I feel like every time we're going to tilt defensively, it's at the bottom of the cycle. And I know that this is just a short-term event, but it feels like healthcare, financials, utilities, probably overdone right now.
Okay. Do you lighten up on technology?
Well, I think big multiple, heavy momentum stocks, I think you continue to stay light of. They haven't traded well for a long time. And I would go back to where we are in rates. I think no matter what you want to say, and every time feels different, and so it's easy to say that nothing ever happened every other time. Look, we haven't been at this level in rates in a long, long time. We haven't been at this level of rates in 4 years. You're actually at 10-year highs on the 2-year note. I actually think if I listened to Powell this week, and he spoke a couple times, and by the way, this guy sounded even more hawkish to me than he sounded at the Fed meeting last week. So it's strange about this because the Fed under Yellen and under Bernanke have continued to be very dovish whenever they had an opportunity to actually walk the market back. Powell did not do that this week. And I think that the Fed really feels like they must go.
Good for him, by the way, because he shouldn't walk it back.
He shouldn't. They shouldn't care, right? Theoretically.